Today, where will rates take us? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Peter from Mozo. Hi, Peter.
Hey, Martin. Great to see you.
Yeah, thanks very much for coming back on. And look, I wanted to pick your brains. Last week, of course, the RBA made the next move up, 1.35% now. And I wanted to see what your readings were in terms of what the rates are doing, who's putting rates up. And maybe we can touch on refinancing too. But let's start with those rate moves, because pretty much everybody's now passed the rates on, haven't they?
Yeah, over the past three rate rises, we've seen pretty much every bank and every lender increasing their rates by the same amount that the RBA has increased the cash rate. The big four banks, the average standard variable now is 5.76%, and that is a jump of 135 basis points, exactly in line with how much the RBA's moved.
Right. And pretty much large players, small players, and even some of the non-banks, I think, are all pretty much following suit. So it's an industry trend, isn't it?
Yeah, in the past, we've seen some of the smaller players tend to be a bit more favourable with the way they handle interest rate adjustments. But this time around, that's not the case. Everyone is going for the whole amount. There have been a few exceptions, but they have been very small lenders. You'd be hard pressed to find them.
And what about on the deposit side of the equation? Because it always seems to me that they're very quick to put the rates up on the loan side, but the deposit rate movements tend to sort of drift through subsequent.
Yeah, deposit rates are definitely lagging, particularly at call rates. They have not increased by anywhere near that amount. We're seeing the best rates at the moment stuck around the 2.15% mark. Unless you happen to be someone who's a bit younger, the sort of 20 to 30-year-olds, there are a couple of accounts out there that are competing for those customers, and they're offering 3% or 2.5%. But for everyone else, you'd be lucky to get 2% at the moment, which is well below the inflation rate. So going backwards right now.
And what did you make of the CBA moves who started it with the very significant hikes of fixed rates? It seems to me that they're trying to say, don't go near fixed rates. We want you to go variable, because what they're really doing is outsourcing the future rate rise risk to the borrower, aren't they?
Yeah, absolutely. The future is extremely uncertain at the moment. It's hard to tell whether in a year's time rates are still going to be going up, or whether they'll have stopped or even going down again. And the banks have absolutely hiked those fixed rates. It's really dramatic what's happened in that space. If I look back at December, the average fixed rate for any term for owner-occupiers was less than 3%. But now the average for each term is more than 4%. And for 4 and 5 year options, the average rate is closer to 5%. So it's a huge change in a 6-month period.
I also note that the investor loans for fixed rates as well as variable are still significantly higher. So that they are still affecting, the investor side of the fence quite significantly too.
Yeah, absolutely. The rates are going up for everyone. There's no one immune from this. Look, I think the story that I am seeing right now, though, is that while the major players have put those huge increases in and basically said, take a fixed rate at your own risk, there are still some smaller and regional lenders that are offering okay rates, certainly compared with the big guys. So if anyone is still interested in getting a fixed rate, I would strongly advise do your research, hunt high and low, don't leave any rock unturned, and there are some okay rates out there that are worth considering.
Yeah, that's a very important message, because, of course, it's always the majors who, catch all the headlines. But some of the smaller players, the fixed rates that they offer are definitely, in the money rather than out the money, which is worth looking at.
Yeah, it's a really interesting position at the moment. The big guys are just saying, no, we don't want your fixed rates. The smaller guys are still, to some extent, competing.
And what about credit card rates? Are they moving up, down, sideways?
Credit card rates have been remarkably static. They are not going up at all. We have seen a couple of really small lenders implement increases to their credit card rates, particularly with some low rate products, but very much in line with the RBA. The big guys, not moving at all. They're very static.
But you could argue they were so high to start with, they don't need to move them because they're, frankly, anybody paying, interest on credit cards are paying well over the odds generally.
Yeah, and that's been the case for a long time now.
Nothing's really changed. Now, I wanted to touch on then the other really interesting information set that we got. We got the ABS series for new loans, and the amount of refinancing that's going on at the moment is dramatically high, isn't it?
Yeah, people are looking around and seeing that they're getting hit with large increases and finding that there are other options out there for them. So yeah, while everyone's lifting their rates basically by the same amount, if you're with one of the more expensive lenders, there are plenty of cheaper lenders out there, at least relatively speaking.
Right, and that means, of course, going into the comparison sites like Mozo and looking at what's available and essentially seeing whether you can do better. And of course, it's worth underscoring, a lot of people will be able to do better, particularly if they, got a loan a little while ago, and if it's a variable rate, of course, or even, some of the fixed rates. Well, you wouldn't want to break a cheap one because they're going to be more expensive. But variable, it is worth shopping around. One of the things I see in my surveys is that quite often lenders seem quite willing. Say you're at 22 years in your repayment cycle on your mortgage, they seem quite willing to be able to say, well, we'll give you a refinance, but we'll extend your term back to 30 years again. What do you think of that strategy? Is that a good strategy or is that a worrying strategy?
It's certainly a tempting option. The recent rate changes can mean that someone on a $500,000 mortgage, and that's not a particularly large mortgage these days, their monthly repayments can be up by around $400. That's a lot of extra money to find. So if the bank is offering you the option to reduce your repayments by extending the life of your loan, it certainly takes some of the immediate pressure off. But when you look at how much more you'd be paying in interest by doing that extension, because you're paying interest for an extra 5 years at least, that really adds up. And it's going to be a lot more cost over the life of the loan.
And I guess that's the point. It's a trade-off, isn't it? You might be able to reduce your repayments a little bit by extending the term, but because of the fact that you're going to be paying a lot more interest over the life of the term, the bank wins on that. And in fact, because you're paying more interest, the amount by which your repayment goes down is actually quite small.
Yeah, but I think if you're going into it with your eyes open, and if it's, say, a temporary measure where you do need to take some pressure off right now, but you think, hey, in a year or two, my finances will be different, I'll be able to pay down the loan faster then, it's certainly a viable option. But you really need to make sure that you've got a way of getting out of the loan and you stick to that plan.
And of course, if you keep doing it, so your 30-year term is still 30 years when you're sort of 50, 60, then you've got a problem, right? So there's an age sort of angle to this too, I think.
Oh, for sure. When you're getting, towards the end of your working life, you need to make sure that you've got a strategy for getting out of your mortgage and clearing that debt.
And we certainly see in our surveys a lot more people as they move into retirement. They've still got quite big mortgages and quite long terms. That means, of course, that their financial footprint as they move into retirement is rather different from what they might expect. And of course, what they quite often do then is raise super to be able to pay the mortgage off, which of course then actually impacts their income later. So there's no such thing as a free lunch, I think.
No, definitely if you're going to be restructuring the finances or restructuring a loan, make sure you do your sums or get some advice. If you're someone who's not comfortable with that kind of calculation, get some independent advice. Make sure that it's going to work out for you, and not throw a hand grenade into your retirement plans.
Yeah, it's very good advice there. And of course, there are a number of calculators, again, on the comparison sites that allow you to sort of look at the various permutations. That's one of the great things, is the more available information for people. Now, I guess the last question then is, RBA lifted last month. The expectation is probably they're going to lift some more.
Yeah, it certainly seems like that's their intention. They've made a pretty clear statement that they're going to keep hiking rates. But I would hope that if not next month, then perhaps in September, they'll take a break from it and wait for it to settle in, see exactly what the impact is on the broader economy. We've already seen the impact on house prices and auction results. A couple of great indicators that show that things are tightening up considerably. So I would expect the RBA to start exercising a bit of caution after, getting us some way back towards what they consider to be a normal cash rate setting.
And what about people's borrowing power? Because, of course, as the rates go up, the hurdle rate at which the banks have to calculate their ability to repay goes up too, doesn't it?
It does. And with people's salaries largely not keeping pace with inflation, that means that their borrowing power is reducing. Basically, every month that goes by, you'll be able to borrow just a little bit less. So, yeah, that's definitely being reflected in the house prices starting to subside.
And I guess that then begs the question for those people who borrowed at the top of the market when, rates were very, very low. Some of those could be finding the pressures beginning to build quite significantly now.
Yeah, there are, pressures on all fronts at the moment. And it looks like we're in for a difficult period ahead, particularly for people who are about to go through an interest rate adjustment, such as coming off a fixed rate and having to find, what rate they're going to be on next, whether it's with their current lender or another lender. There's a good chance that it will be a bit higher than they're used to.
Yeah, well, thanks for your time, Peter. And I guess the message, as always, is it's still good to shop around even now, right, wherever we are in the cycle. And, arm yourself with good information, make good decisions, and potentially you can still save a bit on the way through relative to, where you might be if you don't take those initiatives. So it's never too late to go check, is it?
Absolutely not. More important than ever. And if it takes a little time, it's a great investment.
Peter, thanks for your time today. Really appreciate it.
Thanks, Martin.
Thanks. Bye.